Hello and welcome to Thank God It's Friday. This week, we are in conversation with Jyotivardhan Jaipuria. He is the founder and managing director of Veda Investments. Thank you for joining us this week.
Thanks, my pleasure.
So, Jyoti, I'm going to start off with the question that the Nifty and the Sensex are currently trading at lifetime highs.
Yeah.
How much more can the indices go upwards, at least in the short term?
Yeah, so how much more is always a question of when you're talking about, because even though it's at lifetime highs,
Right.
essentially for the last 2 years the market had done nothing. So we were at more or less these levels at the beginning of 2015 also.
Right.
So if you see, markets have been consolidating in the last 2 years, because before that we had a major run in the market. And so maybe, near term we possibly could see a consolidation phase, we'll see a correction.
Okay.
But probably, 2 years later, 3 years later, will be much higher than where we are today.
All right.
So if you're expecting some correction to come in, and most market participants are given the way the markets have rallied, where do you think the markets are going to get this opportunity to correct for? For example, do you see any geopolitical risks? For example, US just launched the missile strike on Syria, which drove crude oil prices higher, and higher crude oil prices are of course bad news for the Indian markets. Do you think that the markets could use some of these events as an opportunity to correct?
Yeah, so I think a lot of the correction will be global. So even if we see this rally, though it seems like it's a very India rally, it's an emerging market rally where India has been a participant. And a lot of the correction also will be global where emerging markets come off. So if we see, if we just step back a bit, from 2008 to now, there were 2-3 things which were happening. One is, growth was missing.
Right.
Second is, liquidity was aplenty, and, all central banks were expanding their balance sheet, they were cutting rates. Third is, it was a very synchronized move by central banks across the world.
Mm-hmm.
This year, we are going to see a lot of that start to change.
Right.
So we are going to see some central banks cut and some central banks, start tightening. We're going to see Fed start to shrink their balance sheet. And we are hopefully also going to see growth coming back. So for me, the most critical piece is, if liquidity goes up but growth starts coming back, then it's great for market, because we finally get earnings which we've been waiting for. But where the markets will correct probably is, one is, I think political. So it's not, the Syria strike which I'm worried about, because, that normally is an event which we'll tend to forget.
Right.
But one is, the ability of Trump to get tax reforms through the houses, because, after the fiasco on Obamacare, there's a bit of question mark. The second could be Europe, where, these French elections followed by the German elections. And if something goes wrong there, then, the lesson of last year was a lot of these things tend to go much different from what the market wants it to. Then you could see some turmoil happening in Europe, which could lead to a correction.
Okay, so there is the geopolitical risk that you've spoken about. The state elections are out of the way. GST will be implemented. That's more or less been factored in. Are there any other risks that the market currently isn't factoring in? One, of course, would be the possibility of a slightly less than normal monsoon. Other than that, are there any other risks?
So, the monsoon is like it comes every year, and every year we treat it as a big event. So, if you do actually a correlation in the last 15 years, take a poor monsoon and how the markets did, you'll probably find there's no correlation.
No correlation. Right.
So, it's something which I guess everybody wants to talk about, but it's important, but we probably make it sound like it's more important than it is.
Right.
But ultimately, like what we come back to is, we have had very benign inflation. But RBI has very stiff tasks on the inflation. They want it down to 4%.
Right.
So to that extent, one risk is inflation spikes up. The other risk is, it's a very short-term risk, but GST is great for long-term.
Sure.
But probably in the next few months, we are going to see some disruption in trade, some disruption in industry. There'll be a destocking, so the macro numbers may not look very good.
Right.
So, probably those are the things which one needs to just keep an eye on. But I think ultimately it is, when do we get that earnings coming through?
Right.
Absolutely. The recent rally has also said to be driven by domestic flows, though in the month of March we've seen FII flows also returning to emerging markets, but domestic flows have been the key drivers. Do you think they are still here to stay?
Yeah, I think domestic flows will keep becoming a bigger and bigger part of the market,
Alright.
and it's probably good because if you see FIs, they account for like 45% of the free float. So the markets are very, very vulnerable to what happens globally. We have a very strong correlation with emerging markets. So if we can get domestic flows becoming a bigger part, at least this correlation will come down a bit. I think they are probably here to stay because of two things. One is real estate and gold.
Right.
Used to be two places where investors used to go to, and both of those avenues are no longer looking as good as it's looked in the last many years. So partly just the fact that we are demonetization, we are having GST, we are moving to an economy which is getting to get more and more white rather than the black economy which we had. So that part of the reason for investing in both these segments was I have black money.
Right.
And once your black money eases off, then people can invest in equities also. The other is interest rates are coming down. So, and in a secular sense they are down. They may not go down even further from these levels, but they are low, and to that extent the case for equities gets better. So I think if we just look at 10 years later, equities will account for a much bigger part of household saving than it does today.
Absolutely. Coming back to earnings that you were talking about, the third quarter of course does not turn out to be as bad as expected post the demonetization fears, but Q4 of course will be a lot better gauge of how much the Indian economy has moved back to normalization. I just want your thoughts on how you're expecting the fourth quarter earnings to be, and what are the key themes that or pockets that you are expecting outperformance from or that you're watching out for.
So again, when it comes to earnings, nearly half the earnings come from outside India.
Right.
They have nothing to do with India. They are basically global commodities or stuff driven globally.
Right.
And I think the key is to see whether the India part of the earnings are going to go up, because that's my real theme, that over the next 2 years probably we'll see India part doing better than the global part. And I think demonetization led to some slowdown at the retail level.
Right.
The third quarter probably didn't reflect it, because the listed companies which you look at, the manufacturers, they managed to sell to the dealers.
Right.
So probably the fourth quarter will be a little weaker for the domestic players than the third quarter was, but there's some stuff like global commodities which will be do better. So I think we are again headed for this single digit sort of earnings growth on an aggregate basis in the fourth quarter also.
Right.
Okay, so on an aggregate basis, when do we see relatively robust numbers? Because if you're saying that GST is going to a certain extent, disrupt at least the bottom line, is it going to take at least a year and a half more before we can start seeing double-digit growth?
Yeah, so this has been like the cry wolf, right? For the last 8 years, we've seen second half earnings will be better. It's never really come.
Right.
And I've been a little more skeptical than probably the street has been on earnings. But even then, again, we are starting with the standard, this FY18 will be a 17-18% earning growth. I think we'll see downgrades to it.
Okay.
But I'm hoping we'll end FY18 with like a double-digit growth, maybe a low double-digit growth,
Right.
but hopefully a low double-digit growth. And probably by the time we end this calendar year, I think we'll have more robust numbers coming out every quarter.
Right.
Because by then the GST will be out of the way. People would have got used to the system, and we have like a comparatively much easier base to look forward to, because the demonetization played a part. So I think probably the December quarter and the next 2-3 quarters after that will
Right.
lead to a double-digit growth. We may end up somewhere around 15% by the middle of next year.
Okay. And how are you viewing sectors which are linked to capital expenditure? Because are you looking at some amount of revival there? And how will you see them with an investment point of view?
So I like the sector, but first is I don't believe there's a capex revival which you're going to see.
Okay.
I don't think it's coming in the next 12-18 months also.
Okay.
But there is some part of capex which is improving. Government is having a thrust on some areas, roads, construction, probably defense.
Right.
So the part which is not improving is power generation. If you
Right.
go back into history, power used to account for like a third of the total infra spend, and that
Okay.
part is not going to improve for quite some time. But there's some other parts which are improving. So what we are really playing in capex, and the reason I like it is that some of these elements which are improving,
Right.
you play companies who are geared to that. The second thing we have to remember is from the manufacturers of capital goods also, they're all sitting on capacity.
Okay.
They're not going to expand in a hurry.
Right.
So even if they get incremental 10% growth in sales, then what happens is the leverage is huge. And ultimately we play earnings. So, the operating leverage is huge. There's a small increase in top line, but a lot of it just flows to the bottom line because the fixed costs are already sitting there.
Okay.
So I think some of these people will surprise you with the earnings. The ownership is very low in these sectors. And that's why my view is probably the low PE sectors, which have underperformed for the last few years, may do much better than the high quality, high PE sectors.
Right. Okay.
So while we would all like to see some correction in the markets, surprisingly even bad news is being bought too. For example, I'm talking about the Nifty PSU banks, which ended with gains after the UP farm loan waiver announcements. And this is, of course, despite there being implications with respect to credit discipline and a possible contagion effect. And of course, that took many by surprise. And I assume that's you also, because you had also previously spoken about how markets would probably take a farm loan waiver negatively. What I'm trying to understand is, in your belief, are markets not factoring in that second derivative impact of those farm loan waivers into PSU bank prices? Or is the optimism with respect to NPA resolution way too high?
Yeah, so for the market, there's some resolution coming on the NPA, and that is like the critical piece. If you actually get that resolution on the NPA, you can get some more capital for these PSU banks. Then it's like great. Then all problems are solved, and we can get rolling on the economy also. There's been a lot of talk always, and finally when the final resolution has come, it's disappointed in terms of implementation. Right. We'll probably end up with maybe a similar situation. But the farm loan waiver people ignored a bit because, the net impact to the banks is zero in some sense. It's all being taken by the government. The reason I think it's still negative is what you're doing is basically you're giving an incentive for the farmer never to pay money back.
Right.
And just the moral hazard where every 2-3 years I'll get a farm loan waiver. So the only loser is the person who paid his loan back on time. He just thinks I lost out totally.
True.
So I think that's a moral hazard we'll keep facing because we'll keep getting this farm loan waiver every 2 years for one reason or the other.
So do you also belong to the camp which prefers to invest in private banks rather than state-owned banks?
Yeah, so that's been a very standard trade. So we also invested in private banks. We probably didn't do enough in public sector banks. Last 6 months, they've done very well. At these levels, I don't like the public sector banks because, to some extent, the bond rally played out in the third quarter, but the fourth quarter as reverse. Right. So that will hurt them. Mm-hmm. And, stuff like this loan waiver is never good because, the other borrower who's paying on time will hope for some loan waiver also. Absolutely. And he'll never really pay on time.
All right. I also want to address, continuing with the same theme of financials, NBFCs, which were the hot favorite, actually bore the majority of the brunt of demonetization. Stock prices have recovered since then. So what does one do with NBFC stocks now? And even within that larger theme, is there any sub-theme which you like even at the current levels?
So, like just taking off on the old conversation, the loan waiver, it does not hurt the banks, but where it may start hurting is the microfinance
Absolutely.
Companies. Because again, for those borrowers, I took from a bank, I'm not paying, why should I pay this microfinance company? So that's a segment I would actually get worried because of this loan waivers, and I would be cautious on them. There's some other NBFCs we like, which are more get to lending in various areas, but generally it's something which I think it's a toss-up between do you like the private banks or the NBFCs. And I would say we are 50-50 in both of them.
All right.
You spoke about low Ps versus high P companies right now. What are the themes that you are waiting to buy or areas of opportunities that you currently see in the market?
So, the way we run our portfolio is the 3 U's. So, we look for undervalued, underowned and underloved stocks. Yes. So, that's what we really look at. So, we are always trying to think on trading, trying to think where the next, 12 months later, where will the big theme be?
Right.
And so, that's the reason I said I think these high PE stocks, they're all very good quality, but they've had a great run. Right. As the economy turns, then, people start thinking of, okay, these are things which are not really going to give me a big delta, so let me go to the delta. So that's the reason we like some of these infrastructure and capital good companies, some names in auto and probably some of the banking and NBFC names.
Okay. All right.
All right. Thank you so much
Thanks
for
a lot.
joining us with your time. Pleasure talking to you. And for you guys, look for 3 U's while investing. Undervalued, underowned, and unloved is what his advice to you all is. Thank you so much for watching, and stay tuned into BloombergQuint for more news and updates.